Hi, everybody. Good morning. My name is Jonathan Skermetti. I'm the Chief Deputy Attorney General for Tennessee, and I have been voluntold to moderate this panel. So it is my pleasure to introduce a very distinguished group of panelists here. We start to my right with Tom Brown. He's a partner in the Antitrust and Competition and Global Banking and Payment Systems practices in the San Francisco office of Paul Hastings. He previously served as a vice president and senior counsel at Visa USA. To his right is Brian Quintens, who is a commissioner for the Commodity Futures Trading Commission. He's worked on the Hill. He has an MBA. He worked in the financial markets, and he has been appointed to the CFTC. And to his right is Rob Jackson, commissioner of the Securities and Exchange Commission, who was appointed in 2018. He comes from an academic background in New York and previously worked on TARP at the Department of Treasury and practiced law at Wachtell, Lipton, Rosen, and Katz. So, gentlemen, thank you very much for being here. We really appreciate you offering your insights into this fascinating and complicated space. So let's start just by talking about the current state of cryptocurrency regulation. Brian, do you want to tell us what it looks like from the CFTC's perspective?
Sure. First of all, thank you for having me. It's a great privilege and honor to be here with you today. And the CFTC, let me just first say, I think has a really strong relationship across the law enforcement spectrum, from the states up to the national level. Works very hard with all of our counterparts to ensure that we're bringing enforcement cases cooperatively. And I think it's had a lot of success in doing that. But let me back up and maybe start with some definitional constructs that then feed into what our regulatory jurisdiction is and is not, and how we think about that landscape going forward and where some of our concerns may lie. First of all, you'll hear the SEC more, but the discussion of these assets, you hear a lot of discussion around what they actually are. Are they a security or are they not a security? Some people say, are they a security or are they a commodity? Interestingly, under our statute, the Commodity Exchange Act, almost anything that can be traded or bought and sold in interstate commerce is already a commodity. So there isn't really an active classification or a definitional determination that we have to make as an agency for a commodity to be, or a product to be in our jurisdiction. Whereas if the SEC determines that something is a security, I think about that as it's a commodity security, but it gets carved out into the SEC's jurisdiction. And so that's an interesting dynamic that gets presented, where one agency has some very difficult, I think, sometimes and challenging decisions to make, and the other one doesn't necessarily have that same authority, but the decision that's made by one affects the jurisdiction of the other. So there's obviously a very close relationship that our agencies have to have in thinking about that landscape, especially from an enforcement perspective, so that we know who should be bringing which enforcement case. So when you think about what is not a security and what is a commodity, I break up federal regulatory powers and functions into kind of two main areas. One is oversight and one is enforcement. One is preemptive, setting standards. One is after the fact, which you're all familiar with, in bringing cases. The CFTC has oversight and enforcement powers over derivatives on commodities. We have only enforcement powers from a fraud and a manipulation perspective in the spot trading of commodities themselves. So we have no authority to set any standards, any oversight standards, codes of conduct, conflicts of interest, capital requirements, record-keeping obligations, disclosure obligations on any spot commodity platform. When I say spot commodity platform, you can think of what are called crypto exchanges. They're not exchanges because they're not registered with either agency as a designated contract market, a DCM, or as a stock exchange with the SEC. They are, spot commodity platforms, and that I think is a challenge for us because there's a lot of activity that we see and that is known about on those platforms that doesn't necessarily comport to the regimes that have been put in place to govern national, international commodity derivatives exchanges or stock exchanges. For instance, a number of these platforms have their own proprietary trading desks. I mean, that's an amazing business model. You can actively trade against your clients and not have a federal overseer to prevent that from occurring. There are the potential for market manipulation to occur because of a lack of surveillance. Now, when we could bring a market manipulation case against the spot trading of commodities, we also try to classify and prioritize manipulation cases in terms of whether or not they are directly impacting derivatives markets first. And unfortunately, we have had our hands full there. We're a small agency. We're 750 people. We have about 170 people in our enforcement team. So maybe bigger than some of your offices, maybe not, but certainly small from a federal perspective. And so as we hear about cases or the need to prosecute fraud, particularly from you, we're very interested in partnering with you. So let me leave it there.
Thank you. And Rob, what does it look like from the SEC?
Well, let me start by joining Commissioner Contends and saying what an honor really it is to be among the attorneys general and to be talking with you all about these important issues. This is really cutting edge. Every day I learn something new in this space. And let me just start by being clear. You're absolutely right that the coordination between our two agencies has really been crucial because the jurisdictional questions are thorny and challenging, and I just think it's been a great partnership. And I think that's a credit to your leadership, to Heath Tarbert's leadership, and to my colleague Jay Clayton's leadership. It's a really fascinating interagency challenge as to who does what when and how do we coordinate that work. And Brian, you've really been extraordinary. I think the leadership is really remarkable. I'm just going to footnote a couple of things that he said from the SEC perspective. So let's start with where you began, which is with regard to the hard questions we face about whether something's a security. It turns out that's a harder question than I think I used to teach it when I taught securities law. And I think the SEC has done a couple of things that I want to flag for you guys that you should be aware of as you think about these issues back at home. The first is the director of our Division of Corporation Finance, Bill Hinman, gave a terrific speech about a year and a half ago, where he laid out a framework for how we are thinking, how our staff and at least how I think about whether a particular cryptocurrency is going to be thought of as a security. And that framework is a first cut. It doesn't answer every question, but it gives you a sense of the various things that we think about under the famous Howey test that dictates whether something is likely to be treated as security. I thought that was a great speech and a good step forward, but actually what happened next was, I thought, even more important, which is that the private market got together and came up with a rating system to start to think about what are the risks that this particular thing is likely to be a security. And I don't know if you've taken a look at this yet, but it's an interesting development. And I'm not endorsing any particular approach, but I will say that the marketplace has begun to put some guardrails around this so they have some more certainty as to whether and what they're working with or trading is going to be subject to the securities laws, and if so, how. So I would urge all of you to take a look at those private market developments, get a sense for the guidance we've had, and that's really what we've done with respect to defining the question so far. I think there's going to be a lot more from us at the SEC in the not-too-distant future in some of those areas. We have to keep responding because the market is moving so fast that to keep up with that challenge, you really do have to keep giving guidance and engaging with the market. That's first. A second area where we face these questions has to do with exchange-traded funds, ETFs. And I know that sounds so sexy and interesting. Not really, right? Yeah. But let me tell you why actually I think it actually is important. So in the process of creating an ETF at the SEC, there's an application and approval process. And we've had a number of folks come into us from the market and say, we'd like to do a fund where the underlying is cryptocurrency. And we've had to ask ourselves the very, very challenging question as to whether or not we're comfortable with the underlying market. And we had a famous such case involving the Winklevi. Is that the plural, man? Yeah, I don't. So sorry if it's not, but it involved the Winklevi, and they came to us and said we'd like to create an ETF, and we publicly denied that application. And I want to tell you why. We were worried that the underlying was trading in a market that wasn't yet so mature. And when you're dealing with a nascent market of that kind, you worry that not too much money and it won't take too much clever maneuvering to manipulate it. And our concern was that an ordinary investor gets into a fund like this. ETFs are much more accessible to ordinary retail investors. And the underlying ends up manipulated, and the asset class ends up painted with a brush that just doesn't make sense for the market. So we denied that application. At the time, I didn't think that was a very close case because the underlying market was not quite so developed. I want to flag for you something here. I think the underlying market is changing. I think the liquidity is improving. You discussed a couple of developments that have been really important. And to the degree that it is, we are going to continue to update our views about these things because we're sensitive to the liquidity and manipulation exposure of the underlying. That's part of our task when it comes to reviewing ETF applications. So stay tuned for more on that as well. And then finally, there's enforcement. And you talked a lot about this. I got to say, putting the crypto space to one side, something that the SEC did in a related area that's worth noting, I'm really proud of our work in the initial coin offering space. Because I can tell you right now, there were a lot of lawyers out in Silicon Valley giving the view that you could raise money using this ICO approach, that you could avoid application of securities laws, and a lot of people were getting hurt. And I have to tell you, I think Jay Clayton, Steph Avake, and Steve Pekin, who are enforcement co-directors, they just absolutely killed it on this. This is when the government works well, this is what it looks like. What they did was they got out ahead of it. They made clear to the market that their judgment about what was and wasn't a security might not comport with the law. And they got out in front of a lot of ordinary retail investor losses. And I think that was a hugely important development. They really, it was before I joined the commission, but they did a really exceptional job. I think that market, along with the crypto market more generally, is maturing now. So I don't worry so much, but I got to tell you, I heard some sad stories in our enforcement cases about ordinary retail investors, IRA money, 401k money that was lost in some of those ICO frauds. So I'm very proud of the fact that we got out ahead of it. And I would urge you to keep an eye on that space in particular, because there are a lot of ordinary folks who are getting hurt in that area.
Thank you. And Tom, we've heard from a couple government regulators. What does it look like from the industry's perspective?
Well, I guess I'm the designated Silicon Valley piñata, but I was not one of the lawyers telling people to that they could sort of freely introduce those instruments and defraud people. So I too want to thank the National Association of Attorney Generals for inviting me. I, as somebody in private practice, I can't claim to have the same cooperative relationship with you all. We're often on the other side of the V. But I do want to thank you, because I do think of you as a major source of business development. So, and it'll be a good year for the practice of law in the United States this year. So, and I think a lot of that goes to you all. So thank you. So I want to back up. And talk a little bit about the crypto space generally, and then talk about the regulatory issues, because I think we've obviously taken this conversation in a direction related to what I would describe as one of the major activities in connection with virtual currency and distributed ledgers, and that's speculation, right? So obviously an important function, and something that we as humans seem to take a great deal of interest in. So whether it's football scores or the price of what are literally strings of numbers, people do like to bet on those ups and downs. And we have two very well-developed regulators, the CFTC and the SEC, that are in a position to police. And I think over the course of the last 2 years have done a good job of sort of setting guardrails with respect to those issues. I think there are some interesting sort of next questions, and we can come back to some of those. So, for example, the SEC took a baby step in the direction of embracing fund access to something related to Bitcoin in the approval of a petition from Stone Ridge and their NYDIG fund, which is actually built on top of something that the CFTC has allowed, which are derivatives related to Bitcoin. But I think it does sort of then raise some additional questions about where does that go. But again, right, so speculation is just sort of one thing, right? Like, there is something else that's going on with respect to these technologies. The second, and at least the one that's sort of of most interest to me, both academically and professionally, having been in the payment space now for almost 25 years, which is the full digitization of money movement. Today, although this seems crazy, right? Like it is actually easier and faster to download a full-length motion picture onto your personal device than it is to move money from one bank account in the United States to another. So just think about that, right? So like the billions of bits associated with watching, if you're like, because next week is like, there's a Star Wars thing happening. So if you're trying to like relive the entire oeuvre, right? So you can download those movies faster to your personal electronic device than you can actually move the funds from your bank account to the Disney bank account in connection with that transaction. And we have an enormous amount of infrastructure built around sort of allocating the risk associated with those transactions between the time a consumer initiates a payment, whether they do it through a device or at a point of sale, and when the funds actually move between their financial intermediaries. Now, not many people have been paying attention to that until Facebook took a bold step to announce that they would like to actually create a token that enable all the people who are connected to Facebook to engage in commerce on their platform. And you might think, well, like, how dare they? Which was, in fact, some of the reaction here in DC. But as one of my good friends, Brian Brooks, has observed, if we like to talk sometimes about states as countries, like California likes to sometimes say, if we were a country, we'd be the 6th largest economy in the world, and that's true. Turns out, like, if Facebook was a planet, it would be the 2nd largest planet in the solar system by the number of humans, right? So more than a billion, way more than a billion. So it's kind of natural to think that you want to create an instrument of commerce to enable the people who are connected to exchange value, and it turns out that's incredibly difficult. And this takes me to the sort of key regulatory point. The United States, unlike most of the rest of the world, does not have and does not treat the movement of money as a distinct and regulated activity at the federal level. We treat it as an adjunct to the business of banking. So if you look at the major intermediaries for the movement of money in the United States, they are either sort of quasi-public entities. I'm not sure how you all feel about the Fed, whether it's part of the federal government or not part of the federal government. People go back and forth on that. So you have the Fed, or you have associations of banks, the clearinghouse or NACHA, which are themselves not directly regulated, but regulated as service providers to banks. You have Visa and MasterCard, 2 enormous institutions, one of which I am proud to be an alum of, neither of which is directly regulated. And PayPal, which is sort of the exception that proves the rule. PayPal is regulated, alone among all of those, but it holds licenses at a state level. And so when you compare the regulatory framework for the movement of money in the United States, crypto or otherwise, right, to other frameworks like the ones that exist in Europe, in South America, it's kind of a travesty, actually. And if you talk to entrepreneurs who are working on projects, whether they're in the crypto space or just other kinds of projects in the fintech space, what they will say is that trying to figure out how you can plot a course to provide a service to consumers in the United States, given that regulatory, I sometimes describe it as a quagmire. I think here with all the flags on display, I'll describe it as a crazy quilt, is impossibly difficult. And independent of the difficult issues that we've heard up here with respect to the treatment of spot markets for commodities or whether we're going to call some string of numbers a security or not. And then there's sort of a third thing that I think kind of gets lost when we talk about virtual currency. So as is true for much technology, it tends to get obscured in semantics and vocabulary. So we talk about things like blockchains. Who's heard the term blockchain? Who thinks they know what a blockchain is? Right, so most of the hands went down. So whenever you hear blockchain, just substitute database. They're just databases. So they're just ledgers that track information. The thing that's interesting about distributed ledgers, and we can come back to the crypto asset piece, is that they have the ability to reconcile without a single hierarchical server. So to pick on my former employer, Visa, again, right? So if you wanted to sort of mess up Visa's ledger, you really only have to attack one instance of the database that Visa maintains, the core one, right? Attacking a distributed ledger, much more difficult, right? Because each instance of the database is itself a record of all of the information. And so that creates new ways for people to interact and organize themselves. And for somebody like me who went to the University of Chicago, like that's kind of cool. Like, so, and the Satoshi blockchain in the sort of creation of and dispensing of this digital asset to people who perform sort of specific functions, like has arguably launched the most successful open source project in the history of the world. And that we don't really pay any attention to either, and that sometimes gets lost and obscured by the conversations about speculation. But so to bring this back to your question, the state of regulation, like the state of regulation with respect to non-bank financial services in the United States, and I recognize this as an unpopular opinion, perhaps in front of a group of people who represent fundamentally states, but this is a place where we can collectively do better. It's terrible. It's just abysmal, and it puts us at a competitive disadvantage to other parts of the world. So let me stop there.
Well, let's follow up on that for just a minute. How would better regulation be good for America? I mean, what benefits would we see from the kind of changes you're contemplating?
I mean, so it takes enormous transaction costs out of the system. Namely, if you have much of the practice at the Paul Hastings FinTech practice is devoted to answering questions from individual state regulators. Generally speaking, not attorneys general, to be clear, but each of you has a companion as a state on the state banking side. And it is those departments that tend to regulate non-bank providers of financial services. And that is an incredibly costly exercise. So for example, if you're an entity like PayPal and you have money transmission licenses at the state level and you want to change a director, I can promise you it's going to cost you at least $250,000 and perhaps as much as $500,000 to get the requisite approval from all of your state regulators. Like that's, I mean, I love it, I guess, right? I mean, like, but that's crazy. You also create enormous inconsistency in how products and services are governed and handled across state bounds, because each state banking department can choose to interpret, although the underlying legal text tends to be quite similar, so they can choose to interpret it differently. So we have this sort of running dispute in the United States, probably not, on anyone's mind but my own, as to whether if I choose to designate somebody as my agent for receiving payments, whether that person, in collecting a payment, needs to obtain money transmission licenses in each of the 50 states. Like, really? Like, didn't we answer sort of principal and agent problems 300 years ago in the common law courts of the United Kingdom, before we declared independence. I can tell you from my conversations with state banking regulators, not always. So there's just enormous efficiency opportunities associated with creating a coherent regulatory framework. And it doesn't have to be top down. Like, it doesn't have to be imposed by the federal government. It can be bottom up, right? Or it can be both together, which is how the European Union has done it with their Payment Services Directive. There's a federal framework, there's a European-wide framework that each of the member states then sort of plug into and adopt that enable people to port their permissions from one state into another. I can drive anywhere in the United States using my driver's license from California. Why can't I offer services? Like, we can do better on this.
And one quick follow-up there. Are there any efforts that you're aware of for uniform legislation to remedy this issue?
So the Conference of State Bank Supervisors has an effort. I participated in the Uniform Law Commission's effort to create a regulatory framework for virtual currency. So there are some, but I think they don't get the attention or the investment of time from the people that need to invest time in them if they're going to be anything more than purely academic exercises. I think back to the point that General Fox made about civility, like whatever our sort of policy differences are, we should be able to agree on some core principles to enable commerce on a nationwide basis. Like, it doesn't need to be this hard.
And taking a look at the current state of the market, I mean, I think everybody's heard of Bitcoin, and you have other participants like Ethereum, and you have almost joke currencies like Dogecoin. But there has been one significant and highly public effort to enter this field, and that was Facebook, who partnered with as many reputable institutions as it possibly could to put together a pitch on Libra. And that pitch was made to the SEC, wasn't it, Rob?
I think the conversation started with our staff, yeah.
And what does that look like? How is that received by the government, and where does it stand now?
So a few things. First of all, do they make you do this too? I have to say,
Government's a big place.
Yeah, man. I mean, everything I just said and I'm about to say are my views, not my colleague. Oh shit, my lawyer's not here. Yeah, my colleagues' views. It's just my views. Although I find it frustrating that they make me give this caveat, so I always add. I'm sure, given enough time and wisdom, they're going to realize I was right all along. So I think it's very hard, as Brian correctly points out, to speak on behalf of the government. It's even hard. I can't even speak on behalf of the agency, but here's what I can say. I think the fundamental underlying thesis, my reaction to the presentations I've received about Libra, the fundamental underlying thesis, has lots of appeal for reasons that you've hinted at. I think the process of fitting that into our legal frameworks is just getting started. And I think if you ask the folks at Libra, they might say that if they could do it again, they might have thought those questions through in more detail before rolling it. But that's just me speculating. I don't know. What do you think? Yeah, I mean, I think they might say it would have been useful to sort of try and figure out, not just to generate the consensus in the market, which I think they did, that this would be exciting and useful and interesting. And as you say, many very credible, important institutional participants were part of it. But also to say, what's our case going to be for where this is going to fit in the securities and various federal oversight mechanisms? And I think that process is just getting started.
And that's obviously a pretty hefty group of institutions putting together a potential cryptocurrency. Is there room for smaller entrants into this market still, or have we reached a point where only significantly capitalized organizations are capable of making a difference?
Well, let me take a shot at that. I mean, I think from a regulatory perspective, I think the more decentralized a process is for governing a crypto product, the less or none regulatory jurisdiction applies to the product itself. And the more we look at or it is viewed as how it's used. And that's where AML laws come into place, and that's where KYC laws come into place when there is the money transmission aspect from, at least now, from a state license perspective of the exchange of money into these products. The more centralized that governance process becomes, then the more either or all of us look at the entity itself, what it is doing, the choices it makes, and who it affects. And I think that's kind of one of my fundamental takeaways of the conversation around Facebook is that they at the end of the day, while large, they still had a centralized process. There was still an active management component with uncertainty around what was being held. And that seems to implicate a number of existing regulatory frameworks that are currently in place. But as you look at things like Bitcoin or Ether or projects on the Ethereum network that are more decentralized, I don't think that those regulatory concerns apply. So I think that there's the innovation aspect of this that I think Tom did a really good job of discussing. This has unleashed a tremendous amount of thinking, of innovation, of efficiencies, and I think the biggest efficiencies that you can really gain in this space are combining the innovation here with the traditional finance system. That's where most value is going to be created, even though there has been value created in this atmosphere itself. And as those things combine, we'll have to see whether or not there are challenges for the regulatory community. We all have to deal with our own statutes, our own mandates, and right now we don't have the authority, as I said, to set oversight standards on platforms, but we do have fraud jurisdiction. We are also concerned about manipulative activity, but our markets are different. The derivatives markets are hedging markets. The securities markets are capital raising markets that have much more of a retail end user component to them, or much more a retail component, whereas the hedging markets are end user components. And so our standards may be a little different there, but I think that those are legacy issues based on our markets that we regulate.
And I know with respect to states, Arizona's been doing a lot of work on a fintech sandbox, and I know others have talked about it. Is there any opportunity for that sort of regulatory opening for smaller participants at the federal level? Or are there any other aids to innovation that the federal government's offering, either by itself or in conjunction with the states?
Not with us, unfortunately, and I think this is similar with the SEC. I don't know, Robert, but unfortunately, the Commodity Exchange Act and our ethics laws would view the free use of technology in a sandbox as a prohibited gift. So therefore, we cannot participate or construct an innovation hub or a sandbox. We do have a group called Lab CFTC that is designed to interact with innovators and understand what they are doing, whether or not it should inform new rules that we create, maybe give a kindly reminder to some folks that we interact with and say, you may be getting close to a regulatory environment with some of these products. But as of now, we can't form our own sandbox to specifically demo technology. We have joined the Global Financial Innovation Network, GFIN, as an observer. So that's kind of putting our toe in the water there. But there are some weird and complicated rules around demoing technology specifically.
At the SEC, we've taken a similar approach. We have FinHub, where we have market participants. We have conversations. We bring people in. We engage with them and talk with them about where they're headed and why. And I want to offer folks a name to remember. There's a tremendous person at the SEC, Val Sapanic, who oversees a lot of this work for us. Comes from an engineering background, and you'd have to do this well. Market participants tell me they can come in, have a conversation with her, and as Brian says, are we getting close to a regulated environment here? If so, how close? If so, how could we ameliorate those concerns? And I think that's the best we can do at the moment. And I think it's valuable because my sense from the marketplace is people come out and say, okay, at least I have some understanding of what will be on the minds of regulators if we move forward with this. And I will say this, I think I've also heard from the market that what they'd like is a lot more certainty than that. They'd like a much clearer set of rules of this road. And I think what's hard about that is that the market is moving so fast that it's hard to know what an ideal set of rules look like. And it's also hard to imagine that the rulemaking processes at agencies like ours, or I'll speak for ours, the APA process you'd go through, would be nimble enough to I'll tell you right now, if we had made that proposal 18 months ago, it wouldn't make a ton of sense for the market we have now. And I don't know if that'll be true in 18 months, but that would be a challenge, which is why I think the FinHub approach with Val and her team has been a useful one, because it's nimble and can respond to the day-to-day challenges of a market like this.
So I've done quite a bit of work with regulatory initiatives that are designed to reduce regulatory barriers to innovation. I, for example, am the only human to have gotten a no-action letter from the CFPB that was on behalf of Upstart in connection with the inclusion of alternative data in their underwriting process. Worked with the Bureau under then Director Cordray to develop a compliance management system so that that information could be included and we could address concerns related to disparate impact under the Equal Credit Opportunity Act. But that process, from beginning to end, to secure that no action letter was 2 years. And that's a long time to get a piece of paper that just says that we're not going to enforce. We agree that you're not doing anything wrong today, but we take no view as to what we might think tomorrow. And nor does it preclude the possibility of private litigation against you. So I actually think efforts of the sort that the Bureau did with Catalyst, now the Office of Innovation, the things that the CFTC has done with CFTC Lab and the SEC's initiative, where they're actually opening themselves to conversations with entities that are not directly regulated, is probably more important than anything on the direct reg relief front. I mean, given the number of private and public plaintiffs that might react to anything at this point, public efforts to secure no action letters related to regulatory requirements, be they the ones that I'm sort of most familiar with, so something under the Truth in Lending Act or the Electronic Funds Transfer Act, however odd some of those regulatory requirements might be when juxtaposed against the kinds of applications that consumers clearly want and need, it's hard to motivate a recommendation to a client that they should sort of pin that target on their chest.
And one issue I think near and dear to the hearts of the people in this room is, how have the states factored into this regulatory environment, and what sort of partnerships are there between federal regulators and state regulators with respect to cryptocurrency and any adjacent innovations?
Well, I think that, because of some of the issues that were brought up before around the state licensing of money transmission and the lack of federal oversight over those types of platforms, the states or certain individual states have been doing a lot of the heavy lifting there. In addition, I've suggested that crypto platform, that crypto exchange community come together to try to create some type of self-regulatory structure where they can create standards, audit themselves on the implementation of those standards and have some enforcement powers if the audit discovers non-compliance. I mean, that's a tough sell to anyone that's traditionally not regulated, but I think it's in the interest of that marketplace and the integrity there. And self-regulation actually has worked very well in the futures and the derivative space. So I think that we could draw on some of the experience of some of the states in developing some of those standards to institute something that's broad in scope, but that's still in the marketplace that may or may not serve, as a foundational principle if a federal agency ever gets jurisdiction.
And Rob, you had mentioned that this is a very fast-moving industry. What should people here be on the lookout for going forward? Are there any immediate issues that the attorneys general should be concerned with? Are there any trends that are of particular interest?
Just issues. You're not looking for investment advice, right?
Yeah.
It'd be worth what you paid for it, man. Trust me.
We're modestly compensated state employees doing our best for our citizens. So I think we're more focused on the regulation than investment advice at this point.
Right. Yeah. So I think I would. So I'd highlight two things to be on the lookout for. First of all, I think there's still real risk in this market of retail investors understanding what they're being asked to invest in, getting exposure to things that make sense for them, and looking for protection. So if I were you, I would, your offices will hear about people who found themselves in these products, or who've had these products pitched to them. And what I would encourage you to do is work with us. Reach out to us. The National Association of State Securities Regulators, NASA. Anybody here from NASA? The other NASA, yeah. NASA it's a terrific organization. You all should reach out to them and let them know when you're getting incoming from folks who found themselves in these situations. I know that at the SEC we find that collaboration invaluable. And that's on the enforcement side. More generally, I think as you're all thinking about whether these are investor protection measures, whether you're going to grapple with the harder regulation of money type issues that you're talking about, I think collaboration with the federal government makes a lot of sense in this space. And that's especially true because a lot of what characterizes a fast-moving market like this is just being sure you're on top of it. Just being sure that when someone calls you and says, hey, have you heard of this cryptocurrency, or have you heard of this, and what should I think about it, and where are the resources to find out more about it, that you know the answer to that. Because you can know, in this space, you can know the answer on Monday and not know it by Friday. So I think staying in touch with federal regulators and with the market on this is especially important. You guys can expect this to continue to be an issue in your work and to continue to change at this kind of pace. So I'd urge you to be in touch with us and with the organizations that advocate before federal agencies like NASA.
We're going to come to a close here, but I wanted to see if there were any attorneys general or staff that had a question of our panelists before we close. All right. If not, if you please help me in thanking our panelists for their time. And on behalf of the National